Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, October 25th, 5:18 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Reminder, we would appreciate it if everybody watching the video on YouTube would click the like button and feel free to leave a comment. We reply to all of them. Almost 30% click the like button of the people that watch the video Monday. We appreciate that, and it helps the algorithms get our content into other people's streams that might be interested in investing. Sometimes we get clients from it, and that's all we ask in exchange for people watching this. So thanks in advance. State of the market, we're in a moderate correction, got a little bit worse today. Check the trend gauge over here. Since last week, we've had leaders on bearish/downtrend. Also short term, all 5 of the major indexes below the 21-day exponential moving average. That gets a red arrow too. Same thing with the 50-day intermediate term trend. Red arrow, everybody trending below. All 5 indexes trending below. Long term, a little bit of a mixed bag, but the S&P, which wandered back above the 200-day moving average yesterday, back below it today and making a lower correction low. Certainly not good. And what happened? Well, I talked last night after hours about Google being down after hours, Microsoft being up. They almost, after hours, initially offset each other. Microsoft was up about 4%, Google down 6%, but Google got worse. Microsoft got worse also. Ended up the day only up 3%. Google ended the day down 9.5%. But some of the comments that Google made from a cloud computing standpoint trickled over to Amazon and really just and cloud stocks and really sparked a tech sell-off. S&P back below the 200-day moving average. Big 7 hit hard. The only positive one was Microsoft today. Here are the final numbers. Big 7 down an average of 3.4%. Our 8 growth ETF composite, the RG8, down 2.3%, S&P down 1.43, NASDAQ 100 down 2.45, Dow down 0.32, midcaps down 1.55, Russell 2000 down 1.7, Global Diversified 60/40 down 1.01, bonds not helping again as interest rates back on the rise today. That was part of the reason for the sell-off. In-house GROTECTION down 0.72%. I was asked to comment more on portfolio management and specifically the passive part of the portfolio. And so let me do that right off the bat. So back in, let me do this. Back in 2021, we had a great 2020 after COVID. Growth stocks just absolutely kicking butt. Let's go to 12/31/2020, and let's look at the year 2021. So we'll go to 12/31/2021. And this is going to be pretty eye-opening here. So, hey, everything's looking good in the market here, right? S&P 500 just trending from lower left to upper right. What more could you ask for? Up 27% for the year. How about the NASDAQ 100? Also right there, up 27% on the year. Now, a funny thing happened on the way to getting these returns. Mid-February, growth stocks, they just topped. They interest rates broke to a higher high, and the big gains that we had, we were up 48% in GROTECTION in 2020. Year to date, up another 12% through the first month and a half of the year, and then out of the blue, growth stocks just started selling off left and right. Let me bring up the growth half of the Russell 2000. So here you can see the big outperformance. This, in hindsight, was a climax run in growth stocks. And you can see just started selling off. And by the end of the year, growth stocks, small cap growth, only up 2% on the year versus S&P 500 up 27% on the year. Let's take a look at a few other growth proxies. Here's the IBD 50. Not bad, up 11.7% on the year. Let's look at Cathie Wood's ARK-K. Down 24% on the year. You can see it top. These all topped right around the same time. All started selling off en masse FFTY not bad because they do rotate in out of positions that aren't working and into ones that are working. IWO ending up just barely positive for the year. Kathy, who really doesn't sell, she's got this 5-year time horizon, but down 24% on the year. And what happened is we gave back a bunch of our gains from the top of February, more than we wanted to, and had an underperforming 2021. So in going back and looking at everything that was going on in the markets, we clearly recognized that the underperformance, this is actually bear market action. And in fact, there was a stealth bear during this period in growth stocks. There was another one during this period, and it followed up with another one in early 2022. This meaning corrections top to low of 20% or more. So stealth bear markets, nobody paying any attention to it because the S&P and the NASDAQ 100 were doing just fine. Under the hood, though, if you're a growth investor in small and mid-cap stocks the way we are, we're taking a hit and you underperform, and it doesn't matter how good you did in 2020 if you give back more of the gains than you wanted to going forward in 2021. So we put some rules in place, including what started out as the RG6 is now the RG8, to recognize when growth stocks fall out of favor. Uh, and this has helped us a lot this year to keep away from fishing too much in those ponds, because it just of the headwind of what's going on in the overall growth stock and in particular small and mid cap stocks of this year. So in addition to that, we we want to be able to take advantage of the S&P 500 and the NASDAQ 100 when the indexes are trending higher, as I showed just now during 2021. If we'd kept half of our portfolio focused in there, we would have lost significantly more or significantly less on the drawdown than we did. So since then, we put together a bunch of different guidelines, and part of that is this passive allocation to the S&P 500, depending on how the overall market, how they're doing relative to their moving averages in the overall market. And for the most part, as long as we're above the 150-day moving average, we stick with 60% in the S&P 500. Now, as you go below some of these, we may hold on to this, but we might be, say, short financials, we might be long oils, and some of it offsets one way or another. We might be short utilities. It depends on what's going on with the subsectors of the S&P 500, but we kind of keep this as a passive percentage unless we start to break below the 150-day 30-week, and then even more when we break below the 200-day and the 40-week. Then we start looking at where are we under the 200-day moving average, and then there are other factors to consider. Uh, the slope of the moving averages, if they're rolling over, the market's weaker, the reaction into short-term moving averages, do you rally up into it and then fail? Where are the moving averages again on an ATR extension against their 21-day moving average? And then if we're thinking about adding or trimming, take a look at the intraday stochastics to make sure that we get an optimal entry or exit point. But and that goes back to this protecting capital. All these bear markets occur under the 200-day moving average. So right about where the level where we are right now, just the fact that we're under doesn't mean that we're going to have a bear market. But the losses now are down a little over 9% from the top in the S&P 500. That's you just need a 10% rally to get that back. But it's when you get into these bear market or worse, severe bear markets, that your capital really can take a hit. And that's what the passive allocation is designed to do, is to keep us in, give the market the benefit of the doubt as long as it doesn't start to break down below the 200-day moving average, and then use small cap growth stocks or big cap growth stocks, but pretty much growth stocks as to add alpha to the portfolio when the market winds are in our favor. So that's a little bit more about the uh, passive approach that we have to the overall index. And breaking back below the 200-day moving average today, as you see in the S&P 500, we that SPXL that we put on get back above the 200-day moving average yesterday. We sold it for a 0.12% total impact to the portfolio. We can make that trade 10 times, or in this case, 8 times, be wrong every time and still not lose 1% of the portfolio. It's just a good risk reward trade. But now under the 200-day, we start observing the slopes of the lines. Up here is the 100-day moving average. That's flat now. The 150-day moving average is still trending higher. You see the 50-day has been declining for a while, as well as the 21-day. So definitely some extreme caution, and that's why now under the 200-day moving average and below this 4,200 level, which I talked about how critical that was yesterday. We're below this 41.95. We're right at this 41.86. Um, and there's not a whole lot of support if once you start giving way here, and the fact that interest rates are continuing higher, just not a good environment for the market. So we'll keep more of our powder dry. We bought some more T-bills today, and we'll collect that interest while we wait for the market to sort itself out. So that's the S&P 500. The Nasdaq 100, this 350 level, that's basically right about where we closed. We did undercut these prior lows, and we undercut the lows of Monday, where we had the undercut and rally, but just one day down 2.45%. And just terrible stuff for the big seven. You know, they can lead up, but they're going to lead down too. They led up in January, they led down in Q4 2022. So you can't just bank on those to because they're great companies with great balance sheets. If the overall market's going to go down and they're going down, they're going to take the market with it. If you know, there are different components of the market that are acting fine, like GLD's acting fine. Bitcoin's getting a bid as an alternative currency with the spot Bitcoin ETF apparently looming. But there are some places to park money or to invest that seem to zig when the market is zagging, and in this case, it's zagging lower. So there's the Nasdaq 100. I do want to point out I've been saying that you know, we're still 3.5% above the 200-day moving average, but the Nasdaq Composite, which I don't put a lot of weight in because I mean I don't look at the NYSE Composite either. It's just there's a bunch of stocks in there that I just don't really care about. But the Nasdaq 100 or the Nasdaq Composite is down near this 200-day moving average, very close. Uh, Certainly not looking good either. Let's go to QQEW. This is the equal weighted, and that has broken the 200-day moving average. This looks more like the S&P 500. This is the equal weight NASDAQ 100. So yeah, the big cap stocks, which had the big rally earlier in the year, are still holding the NASDAQ 100 and up above the 200-day moving average still. But you could say the bigger they are, the harder they fall, and that's something we need to be wary of. Let's go to the Dow. Dow outperformed today. Microsoft up helped it, but it's still down 0.32%, hanging out around this 33,000 level. Mid caps and small caps just can't get out of their own way, making lower lows. This just looks absolutely awful. We don't want to catch a falling knife here. Oversold can get more oversold. A lot of people are taking shots at TLT, thinking that bonds can't go any lower, but I'm pretty certain that they can. And again, we don't catch falling knives. So there's the TLT. Let's go to the VIX. VIX up today 6%, back above that 20 level, reinforcing the headwinds that the market is facing. Let's go to the dollar UUP. Dollar was up today, still putting in this handle. So just a 1-day close below the 21-day moving average before reclaiming it over the last 2 days. How did that translate to precious metals? Gold doesn't seem to care as much anymore. Gold up 0.42%, but gold stocks getting hit along with the market, down 1.64%. And silver SLV down 0.4%. Let's flip to the broad bond index now, down 0.76%. So a 3-day rally off the bottom, starting to give more of it back. I showed TLT how much that was down. This means rates are going higher. Here's the 30-year, up 2.60%, the 10-year, up 2.33%, the 5-year, up 2%. So bonds rallying across the board. That hit the 60/40 portfolio today. Hit all 60/40 portfolios today. So here's the tail of the tape. You can pause this, go through it in detail. I'll hit the highlights. After hours, Meta is up about 2%. after hours. They had, I mean, the numbers in their earnings report look good, but ultimately what happens or what matters is the reaction to it. Tomorrow we've got Amazon after the close. Day count, 5 out of the last 6 down. 6 days below the 80 EMA, 21 below, 6 days below the 21 EMA also. um, Sectors. Uranium continues to buck the trend. We're looking at CCJ there, or possibly the ETF, BITO, good. XLP and XLU and SPLV. This tells you everything you need to know about whether the market is in a growth, focusing on growth or on value. These are low volatility and value sectors, and that's what has been outperforming. On the downside, SPHB, that's high beta, semiconductors, and cloud. We'll take a look at a couple of charts here that are holding up, some that are failing, some that gapped, some that gapped that failed. But in-house, despite the fact that Bitcoin continues to go higher, that doesn't translate. Just like gold going higher doesn't necessarily translate to gold stocks, Bitcoin going higher doesn't necessarily translate into Bitcoin stocks either, as Coinbase. uh, our stop was hit today, and with the weak market, we lost 0.1% of the overall portfolio on this. So again, we can be wrong on this risk reward 10 times and still only lose a 0%. It's when it starts working that we can pyramid into it and make some money, but we'll take that small loss in stride. So we sold SPXL. That was the ETF long of the S&P 500 on the reclaim of the 200-day. With the failure, we sold that. And as I said, added more T-bills, reducing our beta to 0.40. The only things we have left are 20% SSO, 1% TBT, and 2% gold. TBT and gold working. We'll look to add onto those, and we'll take a look at a couple of other charts here. But the bottom line on the day, Google earnings report reaction sparked a tech sell-off. S&P back below the 200-day moving average, making a correction low. Yields spiking again. Not the environment. It's not a healthy environment, plain and simple. It's a risky environment. So Meta after hours, let's take a look at this chart. It was forming a nice base, then pulled back, was down today 4%. After hours, it's up 2.6%, right at around 307, so reclaiming the 50-day moving average. Let's go to Google, which really got the stuffing beat out of it today. You can see the big gap down here, giving up all the gains since its breakout on its last earnings report. Yeah, big reaction difference in a matter of 3 months. So it doesn't seem to make sense, but the market was rallying then. So it may, it could be something as simple as investor sentiment and what we're willing to put up with in the returns of the earnings report, but the slowing cloud is everything that I've been hearing today about why Google was weak. Microsoft, on the other hand, their cloud, they're more AI focused, it seems, with their investment in ChatGPT, but their numbers were fantastic. Still ended up only 3% on the day. You can see the gap up there. Relative strength, new high also. So Netflix and Microsoft now, the two positive reactions to earnings. And Netflix continues to make higher highs, but this is on like our top 5 list, but not something we feel like plunging into considering the overall headwinds that the market has. This was a wild ride today. VRT, power components for data centers, initially gapped up 11%, but 700,000 shares hit the tape early to the point that it moved down 10% within 5 minutes, and it was stopped. The stock was halted on the day due to volatility. It made a bounce after it reopened, uh, closed, bottomed middle of the day, a little bit of a rally into close, but a wild ride today for VRT. We had no position. Bottom line is it's below the moving averages. Maybe everybody got out that wanted to sell today. Good numbers, 126% earnings growth, 18% sales growth, good numbers for next year also relative to its PE. So the data center story is intact for them, but the reaction and uh, stocks like this just aren't being rewarded. Weatherford, WFRD, oil leader, reported earnings initially gapped up, then sold off hard, recovered a lot of it in the afternoon before selling into the close. Still a good chart, but oil stocks have been coming under some pressure. as of late. You can take a look at NRGU, which we got stopped out of a couple of days ago, now below the 50 and the 21-day moving average. Just because there's a war in the Middle East doesn't mean that all these oil stocks have to go higher. You have to separate the commodity from the stock. CCJ, we mentioned uranium. This one continues to act well. Vertex, this is another medical stock that continues to hold up well. And two of the leaders from the last growth cycle that are, remember, I am constantly harping on showing relative strength. This is forming a base. It's just a leader. It's a leader, still a leader, had a great run. It's just time for it to form a base. And but it is showing relative strength on this recovery off of the 200-day moving average. Very often, managers, portfolio managers, will come in near the 200-day moving average to support a stock, and it is subtly showing relative strength. So if the market rights itself, this could be forming the right side of the base and will be a prime candidate for the next uptrend. And Celsius, kind of the same situation. Uh, Great reaction, a couple earnings reports in a row, just started to sell off along with the market. They've got earnings in 3 weeks, came down to this 150 level, held very strongly there. You can see all the 150-ish dollar support over here from June and July, and it's showing relative strength as it bounces off that level, forming the right side of the base. So this is what we're looking for, growth stocks with relative strength while the market corrects. And that's going to wrap it. As always, like to hear from you. Email's don@revereasset.com. My partner, Dan Stewart, if you're interested in becoming a client, dan@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you made in the market, it's how much of that you can keep. We're back in protection mode, not growth mode, waiting for a better scenario in the market. And when the market is below the 200-day moving average, that's not a healthy scenario. So with that, I will wrap up the video for Wednesday, October 25th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.